All right. So this morning we are here. Things have been going good. Well, Monday, Tuesday Monday we were closed, but the market still traded. Um, very little volume, of course. Then yesterday we had a big push, and this morning we got another push, and especially the Nasdaq got a super push. The Russell's actually down. The Nasdaq is up 1.6. These guys are all over the place. The S&P's up a 8 tenths, and the Dow is barely up. And the VIX is getting higher. Look at the pop in the VIX. Now that's because it rolled over. This is a prior month contract. This is a current month contract. So it petered out yesterday, and now it's back up to 1665. So there's a brief period of the VIX going down. Now it's back up. Energy-wise, let's go to dailies. So energy-wise, oil had a fun time going to 80, and now it's back to 75 or 76 at the moment. Brent went to 82 and is back to 79.50. Gasoline all the way up to 217 and back to 206 now. Heating oil, we never care about anyway. Natural gas flipping along, kind of consolidating around the $4 line. That's an important point. Let's talk about that. I'm just going to talk about random things that are important today. I do have a plan, so don't worry. But if you have a question, it's a good time to ask because I don't have much of a plan. Natural. It takes me a while to get the keyboard in the right place. It's a little teeny keyboard. Natural gas. God damn. Prices. Natural gas prices global 2024. That's, I was reflecting on this. I'm very good at Google and I'm very good at AI. And it's kind of the same thing. It's like when how you see science fiction shows like Star Trek and stuff, and there's a person whose job it is basically to ask the computer a question. And people make fun of that. They're like, well, what the hell kind of job is that? It's like you just the captain asks you something and you ask the computer something. But the thing is, there is a skill to getting a correct response out of what effectively is a search engine. Whether even if sophisticated AI, it's still a search engine. And if you don't ask it the right way, you don't get the right response. And that's a very important thing to be aware of. So in other words, so I'm looking for this. This is what I'm looking for. I didn't know what it was called, but I know I was looking for it. So I said natural gas prices global 2024. And then I go to images. That's another thing you need to know. I need to go to images in Google. And I wanted to see it because I wanted to show you something. So here's what they call the Henry Hub prices, and that's our local prices. And very good by whoever did this projection, because we are at about $4. Whoever did this projection at the time, and that was the EIA. Good job, EIA. So the EIA projected that into the early part of this year would be up at 4, even though we were down at like 250 at the time that they did it. Meanwhile, Asia and Europe natural gas prices are chugging along where they usually are. Well, usual is a weird word. From 10 in the range of 10 to 17 or 9 to 17, but basically 15. So, and there's a lot of factors, but the bottom line is we are the Saudi Arabia of natural gas. And you know how the Saudi Arabians, they pay like $1 for gasoline in Saudi Arabia? That's because they've got so much oil and so much gasoline and so much capacity that that it's cheaper there before they ship it. It comes out of the ground very cheap at $20 a barrel, basically, because it's easily accessible all over the country. Comes out of the ground at $20 a barrel. They refine it, and now it's 25, and when you sell it for $1, that's a big markup because it's $42 a barrel. So it costs $5 to refine it. A $20 barrel, you're at net 25 out of the refinery. They sell it for 40 at the pump. That's their markup. $1 a gallon is in a 42-gallon barrel. So we are like Saudi Arabia for natural gas. We have so much natural gas in this country that we pay less, far less than anybody else in the world for natural gas. Now, until let's say 5 years ago, LNG, well, in fact, that even says LNG, until 5 years ago, LNG was not a real thing. And that's not 5 years ago, that's 2 years ago. LNG only started coming on the market about 5 years ago and is only just now sort of picking up in capacity. So before LNG, we couldn't really export natural gas. Why? Because it's gas. Because if you put it on a ship, the amount of gas you can put on a ship is not very much because it was gas. So LNG is liquefied natural gas, and you're compressing it. How much are you compressing it? 600 times. So now the ships can take 600 times the capacity that they used to. So one ship can take more natural gas than all the ships that existed for transporting fuel before this. So this is an important concept, though. So what does that mean? That means that our landlocked LNG, our landlocked natural gas that was stuck in this country and would just sell at whatever price it would sell for. And by the way, they would burn off the rest. They would just burn the rest off. There's nothing to do with it. If people didn't want to buy it, it was just useless and there was nowhere to put it. So they'd light it on fire. We have incredible amounts of natural gas. We have more than 100-year supply of the world's natural gas in America. We have more natural gas than Saudi Arabia has oil, basically. We don't go after it because it wasn't profitable to go after it, to drill it. Now it's becoming profitable because we can export it to people who are willing to pay $15. But there's a reality to this, because what's going to happen is our natural gas, as we start exporting it, will get more expensive, and their natural gas, as they start consuming our new supply, will start going down, and we'll find an equilibrium point at maybe $8. And not just because it's in the middle, that's just the math of the thing. So somewhere around $8, we should settle down, and there'll be a great break for everyone in the world except us. We're used to paying $4. So we're going to pay twice as much, and they're going to pay half as much, and there will be a robust natural gas economy in the US to compensate, but still the consumers of natural gas in the US will pay much more. And also, because natural gas is so cheap, there are a lot of people, especially in the Northeast and the Northwest, that have built their homes dependent on natural gas. And that means that they have gas ovens, and they have gas heating and things like that. And their hot water heaters run on gas. Everything runs on gas. It's the cheapest way to heat something. But suddenly it won't be. So little things. See, a thing that seems simple can drastically change the economy. So new homes may not be bought with natural gas anymore. Natural gas pipelines will be different. There should be a massive demand for pipelines, though, because we've got to send the gas out of the country to ships. So any natural gas lines that serve a hub where it can be exported or heads up to where the terminals are is going to be great. Now, even more confusing is when you build an export terminal. So remember that a natural gas tanker takes 600 times what a regular tanker would have taken. So, so one natural gas tanker is taking a substantial amount of natural gas, a very, very large amount of natural gas per tanker. Not only that, though, but the facilities that they build to fill up the tankers have to hold a tremendous amount of natural gas as well. And that means that as you build a new facility and you build the storage tanks and you fill up the storage tanks, you are using a tremendous amount of natural gas even before the first ship leaves the terminal. Once you have the terminal built, then there's still a period of drawdown as you fill up. Let's say 20 tankers are going to service a terminal, and at any given time, 10 are going out. So let's say they're a day apart each or 2 days apart each, and 10 are going out heading to Europe and Asia, and 10 are coming back from Europe and Asia, right? That's 20 ships servicing. 10 of those ships are full. So you not only have the storage that you're putting into at 600 times compression, you not only have the storage you're putting in the tanks, but you've got 10 ships that are riding on the water full of natural gas as well. Plus, on the receiving end in Europe, where they have no natural gas, the receiving terminal that had no natural gas, they were also building a terminal and filling out the natural gas and then putting tankers of liquid natural gas all over the place to deliver to Europe. Or they're converting it into regular natural gas and sending it down the pipelines. But either way, there's still a huge amount of storage. So if you think of it like your house and its pipes, right? You got empty toilets. Think of them as like natural gas terminals, right? So you have empty toilets and empty bathtubs and such, and you've got empty pipes all over the house. And you now have to make the house operational, you now have to fill the pipes and let the pipes fill the toilets and allow other pipes and hoses and whatever to come in and take it out and so on and so forth. That's a lot. In fact, you can even ask here. So let's say, how many gallons of water are used to fill an average home? Let's see what kind of number we come up with here. Oh. An average person uses 3,000 a month. Nope. Uses to fill an average newly, see, we have to get the question right, constructed home. How much water does your household use per month? 100 gallons a day per person. That's not answering the question though. We use, it's interesting. Nobody asked that question. Typical home water flow rate. How many gallons of water are used per typical home? 150,000 gallons. Isn't that incredible? 150,000 gallons of water are used annually. You know? I would think that's an important question. I'm surprised there's no actual answer for it. Let's see, who's smart? Oh, your session expired. Log in. Oh, come on. Yeah, I know that's me. Think we'll find out? Meanwhile, I can ask Bodie. He's better at research anyway. Oh, come on. In a brand new home, how much water is required to fill up the pipes, etc.? See, now knowing that I'm talking to Bodie, I can ask him more vague. Well, I wouldn't say vague, but I can ask him more general question because I know he's going to understand what I mean. See, calculate the total volume required to fill the plumbing system based on average pipe size and lengths. Research any additional factors that may affect water volume requirements, such as water heater capacity and fixture types. Okay. See, that's the difference between an AI and Google. Oh, only 10 to 30 gallons. That's not much. Number of fixtures, bathroom appliances, home layout. That's way less than I thought. Sounds low. Did you include toilets and water heater? Whoop, what the hell is that? What the hell does that mean? All right, so let's say 30 to 50 gallons include toilets, standard fee. Well, all right, so it's not much. So it's maybe less than 100 gallons to fill up a house. What were you talking about? Ay, ay, ay. Oh, no, we weren't even talking about that. I got too confused with all the stuff we were talking about. Anybody remember where the topic was at that time? Got too sidetracked trying to find out the answer. Nope, that wasn't it, and that wasn't it. I totally forgot what we were talking about. I'm sorry. Does anybody remember? Let's start again. All right. Anyway, off the topic of that, unless somebody remembers it. But the point is, research is important. You got to know the background of things when you're checking stuff out. So here we are talking about the main topic of the day, which is going to be what's up with this guy. Policies changing. I like that. That came out well. I just wanted to show like a transition from Trump to Biden, from Biden to Trump, and that was a good illustration. I like doing my own artwork. I don't know, these weird signatures. He does very creative signatures, but they're completely made up. Anyway, so what I wanted to talk about mainly today was about, well, there's two things I want to talk about it, but I want to show you how we do the research and how we look into things. That's what I think is important. So here I'm talking about like JP Morgan set up a war room to cope with the executive order. Some law firms have hotlines for their clients. Manufacturers and retailers are putting together teams to like deal with the tariff stuff. There's a lot of, preparation going into these, and we have to prepare as well. We have to be on our toes for what the new policies are and how the changes are going to affect things. And we have to be really going over our portfolios and determining what's going to change and what should we now be investing in that we haven't been investing in before, and what things are probably not going to work in the new environment. So on December 3rd, we did our trade of the year. It wasn't December 3rd. On December 3rd, we talked about it. We did our trades. Our trade of the years were, oh no, it was December 3rd. That's right. On December 3rd, we did our trade of the year runner-ups. We talked about them in the Money Talk portfolio. We did the actual trade of the year on Thanksgiving for the members. And we had Pfizer, we had Target, we liked. These were already in the portfolio. We made changes to. We liked gold. We did a thing there. We liked IMAX. Like Nokia, 4 new trade. I mean, so many trades. It's funny how that came in. Geo. So at the time, we decided not to go with Geo, but I said it's showing strong fundamentals. Their focus on ICE processing centers and detention centers is perfect for Trump's immigration policies. Geo's potential for increased detention utilization has clear catalysts. A lot of Trump's final solution is priced in, so not quite enough upside in this as of December 3rd when they were up here. I said, so not quite enough upside potential to give us confidence for the top three. And what if Trump's immigration promises turn out like his build a wall promises? Then it's all another load of BS. So that's what I said at the time. So I didn't want to jump on it on December 3rd, but on December 10th, a week later, we decided that we may as well add into the long-term portfolio. So on December 10th, they had sunk. Oh, that's why. So December 3rd, they were up here, and I wasn't too happy about it. On December 10th, they came back down a little bit. And I said, oh, what the heck, let's add into the long-term portfolio, but not a huge trade. For the LTP, this is not a big commitment here. And so, you know, and when I say commitment, the commitment we really make is we're selling 20 puts for $25. So we're committing to buying $50,000 worth of this stock. That's our commitment. 20 puts is 2,000 shares. $25 is obviously pretty far below. It's way down here. It's pretty far below where the price was. The price at the time was here. And we said 25 that we would be willing to buy the stock for. And since then, it's gone blasting higher, so no issue for us. We did sell 30 calls, though, the $30 calls, because again, it was down here and we thought 30 would be okay, but it blasted up on us. So we actually lost ground on the thing. And now we'll get back to the days post. What am I doing? Ah, I see what I did. I didn't open a new window. I went to the thing. Oh, that was the same one. Anyway, and I'm saying so in the long-term portfolio we rolled already to something, but I'm saying to the people who didn't do that, now you can sell the April 35s for 5, and that's fine too. So as it stands, the stock is down. The trade is down a little bit. Our net entry was 5,400. Now it's 4,650, I believe. Yeah. So now it's 4,650, but that doesn't matter because it's on track. So is this trade on track? Yeah, our spread is 2030, and we sold the 25 puts. We're over 30. That's our target. So we're on the way to our $40,000 goal on the spread. We lost about $1,000 on the sale of the short calls that we made already. But so what? We're going to sell the next set for $5,000, and hopefully we'll win one of them when we do sell the short calls. But even if we don't, we've got $35,000 of upside protecting us on the spread. So yeah, of course we're going to keep selling short calls. We have a good probability of doing well on the short call sales. We just got caught with a spike that went up, but that doesn't mean you stop. You know, it's like fishing, and you put a worm on the hook and there's nothing. You put a worm on the hook and there's nothing. You put a worm on the hook and a great big fish comes up. Eventually, you get a great big fish and you make a lot of money. Sometimes you make nothing. You got to keep playing them. If you quit, that's when you lose. So this is how we do our spreads. So this one was easy. And what's the point of Geo? The point of Geo is that they make prisons. They're basically a prison making company, and they also make the detention centers for ICE now. So they're cleared, and they have a system that well, I wouldn't say it works because we don't know the horror stories about ICE, but it doesn't matter. They don't care. Obviously, they don't care because they need more. And currently, all of Geo's business total is maybe housing 500,000 people. So was that monthly, daily? So Geo's total business here is 500,000 people. Oh, I didn't want this one. I want one more detail. What do I not have? If I can't remember the name of it, how am I going to have it? Stockopedia. That's it. Choose a plan or log out. That doesn't make sense. How about log in? Don't you know who I am? How weird is this? Change your plan. I'm not changing my plan. Ugh. Your current plan, $45 a month. So what's the problem with that? That's a lot of money. Geo, NYQ. Geo Holdings, that's them. So if I go there, oh, now it's showing me the numbers. That's weird. Okay. I mean, this is what I paid for. Stockopedia, by the way, is really good if you're following foreign markets because you can sign up for other countries. Not to do a commercial for them when they're such a pain in the ass, but still. Anyway, point being, $2 billion in business. They don't make a lot of money, but that's 500, it's 500,000 prisoners that they're doing. So if they get a contract to double that, and don't forget, Trump needs to detain millions of people if he wants to follow through with his plan. So if they just give these guys a contract just to do 500,000, it'll double their business. So they're trading 22 times earnings now. So if they get another contract, their growth is going to be fantastic. Their profits are going to be fantastic. Look, they're already projecting some huge profits, and we haven't even done anything yet. Wait till they start getting government contracts to deport people and put them in centers and put them on trains and all the other fun stuff that you get to do when you're doing this. So it's they're disgusting people. It's a horrible company. They're you don't want to be associated with them, but they'll make some money. So whatever. That was our logic on that trade. If you wanted to trade with morality, you should have voted differently because that's not what we voted for. The money is going to these kind of things. Now, so that's an easy one. We did it already. I didn't want to waste time. Lockheed Martin, very favorite defense stock. We love them. Exxon, we love. Now, let's talk about how we evaluate other opportunities. Here's Plantair. We'll look at them from okay, PLTR. Oh, Palantir, I say Plantair. So here's Palantir. They have gone too far ahead of their skis, and here you're showing 160 times earnings. Now it was 300 times earnings, and you go to 161. That's fantastic growth. But is that what we want to own? That's a toughie. No, actually, I'm sorry, it's not really a toughie. It's a no. PLT. So they have $166 billion market cap. 166 billion. That is 50, 60 times. Yeah, basically it's almost 60 times their revenues, not their profit, their revenue. And it is 160 times their earnings. I mean, come on, be serious. All right, how is their business described? It's building software to assist in counterterrorism investigations and operations. It's built for principal software platforms. Blah 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 blah. So they're artificial. I'm sorry, not artificial. They're anti-terrorism software, investigatory software. It's specialty stuff. It's AI stuff that they're working on. It's given them a fantastic boost. Oh, I got 2 of these. So over, this is how the company performed. And all of a sudden they get caught up in this AI thing and they go from 25 bucks to 80 bucks. And they were basically kind of expensive when they were at 25 bucks. This is an insane company to invest in. And you look at this and you have to say to yourself, okay, it's not just a multiple of earnings and whatever. How much debt do they have? So we go down to debt. They don't have any debt. They have $3 billion in cash. That's good. But the valuation is 164 billion. So knocking 3 billion off that isn't going to take you anywhere. All right. Do they make money? Yeah, they do make money. They make $1 billion a year. They'll probably make 2 billion a year in the future. That's still 80 times earnings. And that's got to be a couple of years away because there's physical limitations on their growth. They're a software engineering company. They provide solutions and systems, and there's only so many engineers that they've got, and the competition for engineers is tremendous. Because when you see these things, like today, there's this thing that says, oh, they're going to spend $500 billion on AI development over the next few years. Okay, first of all, it's over a few years. Second of all, Microsoft already announced that they were spending $80 billion next year, not over a few years. Next year, they're spending $80 billion. So obviously, other companies are going to spend money too. That was a given. So the market's getting very, very excited about something that really was already announced by everybody months ago. These guys are in a great space. They're gonna grow. Everything's great, but why am I going to pay this much money for this company? I want to find a similar company that does something like this that's in the same area, and they'll grow something that's not already priced at 160 times earnings. So that's why that one's not on our list. We looked at it, but we decided no. Now you have Nucor. Let's take a look at them. Now, Nucor is trading at 15 times earnings, but you got to pay attention. Their prior PE was 12 times earnings, so Nucor plans to make less money next year. That's not good. And we go down here, Nucor's manufactures steel, blah, blah, blah. It operates steel mills, steel products, steel, blah, blah, blah. Old-fashioned fasteners, blah, blah, blah. Companies headquartered in Charlotte, North Carolina. So the thing about Nucor is it's an American steel company. And that should give it a big advantage when we do tariffs and such. So instead, the imported steel is going to go down. So Nucor and CLF should do very well. And US Steel's weird because they're getting people who are making offers on them. But Nucor coming off the $200 peak and falling back to 123, that's a pretty reasonable price to start a trade. So that's step number one. Step number two, we're going to take another look at it and say NUE. And by the way, it's extremely abbreviated because I would read a ton of articles, but that'd be pretty boring for you guys to follow along with. But here's Nucor. They made 2 billion, 1.2 billion, 720, but this is COVID. $6.8 billion, $7.6 billion. Then it faded out. So it's a cyclical company. And that's it. But the potential is for them to make quite a lot more money than they're making now. And the question is, now, this is what I'd have to look into. Did they have any spin-offs, or did they sell off a division, or did they do anything else that maybe means that they're not this company anymore, that they can no longer do what they were able to do in the past? So you have to know that. You have to think about, why did the revenue go down? What happened to it? So on and so forth. So rather than doing any work myself at the moment to get it done faster, and again, just because I can ask an AI doesn't mean I should take an AI's word for it. Where'd you go? Oh, okay. Please give us a full investors report on NUE, and I'm particularly concerned with why earnings fell by 30% from years in the recent past. Is it a cycle, or did they spin off or sell assets that will not come back? So that's the best thing to do, is just, if you're working with the AI, just ask it questions and say, here's what I'm worried about. Here's what I want to get some information on. And don't end with one question, back it up. And don't, once he gives you an indication, you then have to go check elsewhere and verify what he said. Now, Bodhi runs on Perplexity, and the reason I run him here is because they're very good at what's this? What is wrong with this thing? I didn't have any attachments. Oh, that's the stupid toilet thing. Oh, he's doing a lot of research. That's what's going on here. I was looking at the toilet and I'm like, what are you talking about? I thought he's broken. Very slow. I wonder what's going on there. Boy, this is a bad day to have this going on. Maybe I need to set up a new one. Whoop. It seems like it's just being real slow. Whoop. Library, discover new thread. Nope, it's not asking me where I want my new thread from. That's bad. It's messed up. Try Pro. This is Pro. What on earth is going on here? Wait a minute. No, it's on the network. What the hell? He's stuck. This whole thing is broken. Are you guys still there? There's an important point. Is anybody there? Looks like it's working. Thought the whole network's down or something. What is going on? It's like it's really broken. Pro search, get more with Pro. Pro search, yeah, no kidding. Something's really wrong here. All right, sorry. The chicken with Warren. Yep. That's pretty messed up. So now he doesn't have the web access to look stuff up for me. So, all right, I got to think about this for a minute. All right. Anyway, so skipping the whole thing that I wanted to show you, which is very annoying to me. I don't know how this happened. Of all the days for this thing to break, it never breaks. It's clearly broken now. It's just not working. Oh. It is trying to answer. Nope, that's not working at all. There's something wrong. All right, well, maybe we'll get an answer, maybe we won't. But so the point being, though, that I look at Nucor, I'm pretty sure they're in good shape. I want to check them out. That would take a while to research, but conceptually, if we assume that they're just going through a negative cycle and we expect prices to come back, then we can expect that this is a low ball amount, but meanwhile, it's still even that is 15 times earnings because their price is only $30 billion. So they expect to make $2 billion a year. We think things will improve in the future. We think Trump's tariffs are going to be favorable to them. And that then means I want to know how much money they make on exports and how much money they import and what how everything lays out for them. But as a concept, it seems like a good trade, and I would certainly want to sell some puts on Nucor and set up a trade. So how would I decide that? Now I got to go and see if it's worth trading. So we look at Nucor. Let me see if it's worth trading. So we go over to 2027 and I say, okay, so they're at 122, 123. So if I think this is a pretty good bottom, I still would like to have a little bit of cushion but it looks like I can sell the 110 puts for almost 15 bucks, right? Between 14.20 and 15. So and today's a negative day, so I would ask for $15 for the short puts here, right? Now, if I sell those for 15, and let's say now, how much am I willing to commit? Well, in the long-term portfolio, I have no problem committing $50,000, $100,000. So I could easily sell 5 of these, and it's no skin off our back in the long-term portfolio to pick up $50,000 worth of new core when I consider it a value at that price. So we could sell 5 of these puts. And I'm just going to take notes here. So we're going to call this webinar considerations. NUE, well, sell 5 NUE 20 110 puts for $15, $7,500. Now, what do we want to buy? That goes back to how do we feel about new core in the long run? So don't forget, it's a monthly chart. This is a weekly chart. So on a weekly chart, they look pretty good, right? They're way low in the channel, although look at these averages. The averages are crashing down. This is a 200 week. Yeah, this is a weekly chart. So this is a 200 week moving average. The 20 week moving average and the 50 week moving average are crashing down. That's a nasty channel. We had a death cross here, and the death cross worked, and it swung the resistance down here. So the question is, what's the catalyst here? And I think, again, we think the catalyst are going to be the tariffs to turn things around. But this is a very, very nasty downturn on the weekly basis. On the daily basis, still trending pretty hard down. And on the monthly basis, let's say you got support down here, but that's not going to help us for a new trade, right? So we don't want to go heavy on this thing. That's the bottom line. We want to pick a trade. So given that it still may have more downside, we want to set up a trade where we're willing to buy more and do more. So question is, step 1, what if we get assigned at 110.95? We'd be assigned at 95. So to avoid assignment, what could we do? We could roll this to 2 times the $90 puts. And if we did that, we will have effectively sold the $90 puts for $7.50, right? If we sell these for 15 and we roll them down to 2 times the $90 puts, then we will have sold the $90 puts for $7.50. Doesn't matter what the price is here, it matters what we collected up here. So if we sell the 90s for $7.50, now we're into it for net $82.50. $82.50 though is where we absolutely feel this is a dead bargain. So that means I don't have any fear of selling the 110 puts for 15, because that's the same as selling the $90 puts for $7.50. Now I'm only selling 5. Do I mind owning 1,000 shares of Nucor for $82.50? No, that's fine with us in the long-term portfolio. No problem making that call. Now, if we own it for $82.50, then we could sell, and we'll go by the 110 price. That's more than probably we'd get. But let's say we could sell the 110. Let's say we sell the 82.50 calls for 20 bucks. They're 50 bucks now. But let's say we sell the 82.50 calls for 20 bucks, or the 85 calls, whatever. And then we sell. Now these will get more expensive though. And let's say we can sell the $80 puts, which we net 60, for another 20 bucks. Well, that means at $82.50. we can sell $40 worth of puts and calls, and our basis would be knocked down to $40, called away at 80 with 100% profit, right? And if we get assigned another round at 80 bucks, our net is going to be 60. and we'd have 2,000 shares. So I'm already thinking it goes down and it goes down and we get assigned and it goes down again, and we're going to end up having 2,000 shares of Nucor for $60. I don't mind that. I would love to have 2,000 shares of Nucor. I mean, unless something changes that makes them seem very unattractive, but I don't think that's going to happen. So as they stand now fundamentally, and as I can imagine a worst case scenario, which, you know, the economy collapses and we go into recession, you're still going to need steel one day. We'll come out of it one day. So therefore, yes, I would love to own 2,000 shares for $60. The stock's at 120. So I absolutely don't mind selling 5 110 puts for $15. That's just a logical chain of thought. So that's how we come up with that. So I've now decided that even though I don't think Nucor is hugely attractive, I certainly don't mind that trade. So now I have to say to myself, okay, how do I want to play the rest of the spread? Do I want to play the rest of the spread, or should we just sell the puts and see what happens? So here's the logic with the puts. If I sell the puts for $7,500, I got a free $7,500, and I'm looking at Nucor. I have the puts in the long-term portfolio, and we need puts in the long-term portfolio, short puts, because we went over that in the last review that we don't have enough short puts. So I got short puts in the long-term portfolio, $7,500. If it goes up fast, I collect my $7,500. If it goes up slowly, I still have my $7,500 cushion against a bull call spread that I might buy. If I buy a bull call spread, they don't change that much. So in other words, let's say now I would buy the 100s for 38, or let's say 38.50, and I would sell the 130s for 23. So that's what did I say, 38.50? So 38.50 minus 23. So 15.50 on the $30 spread. That's fair. So let's say that I bought 10 of these and sold the 130s, and that's net 15.50, and that's going to be $15,500, but it's also less the 7,500. What I do? What was it? 15.5 minus 750. That's what. So I'm spending net $8,000 on a $30,000 spread. So we have $22,000 of upside. So $22,000 of upside potential if we get to 130. Now, what's the delta? That's the thing. So the delta of the 100s is 76. The delta of the 130s is 58. So there's only 18. So there's only 18 points between them. So what does that mean? That means my $8 spread, well, it's not, I'm sorry, it's not an $8 spread because it's plus back to this. So my $15 spread, right, is only going to change by $1.80 on a $10 move. That's what the delta means. It's 0.18. So for each dollar of movement, the spread's going to change by 0.18, 18 cents. So it'll take a $10 drop in Nucor for me to lose $1.80 on my spread, which is basically 20% on my spread. A $20 drop in Nucor all the way down to 100 is going to cost me $3.60. So I already know that I'm comfortable rolling my puts. What do I feel about the calls? Well, I feel comfortable rolling the calls too, because if it goes down 20 bucks and the spread and my 100s will still be at the money, and my 130s will be way out of the money. So what am I going to most likely do? I'm probably going to roll my 100s down to the 80s for $10. And that's about when we like to roll our spread. So right now it's we said 38.50, and the 80s are 51. So right now it's 51.00 minus 38.50 is 12.50. So right now it's 12.50, and my belief, and most likely, this is from experience, but most likely if Nucor drops 20%, drops $20, then this roll will, instead of 12.50, will be lower. It'll be more like $10. At $10, I would want to do the roll, and I would want to double down on my longs. So because I like everything that's going to happen to me on the way down, and I would continue to press it for a long-term bet. And again, unless the fundamentals drastically change. But if it's only, and when I say fundamentals, I mean the company itself or the outlook is so grim that I don't want to stick with it. But in normal situation, if it's just an economic downturn, if it's just like Japan is this and China is that and blah, 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 and then the tariffs do this and that, and we have a recession in the country, and just got to look at it and say, is this the end of the world? No, it's not. If it's not the end of the world, we're going to need some steel at some point. Boom. And we're back to that. So, and of course, don't forget our main premise is that all these tariffs and everything else that's messing around is going to cause more demand for American-made steel. So we'd have to be very wrong, the conditions would have to change, and so on and so forth. But all that ends up doing is pushing back our time frame. We still don't mind owning a cheap steel company. And believe me, I said the same thing in 2008 when US Steel was like 10 bucks. It's like eventually it comes back. That's why I like plays like this. So anyway, the bottom line is there's no reason not to do this. All right, so it's going to be the 100s for 38.50, selling the 130s for 23. All right, so we're going to buy 10 NUE 2027 100 calls for 38.50. Now I don't know. How crazy, huh? 100 calls, 38.50, correct. And that's 38,000. See, and you can't get freaked out by the numbers because who cares if I'm spending $38,500? I'm going to sell something that's going to cover that. I'm going to sell the 130 calls for, because Nucor is heading down, 23. Got to try to split this somehow. Actually. Let's take a look. Do we have a quick chart? Switch gadget. Chart. When's this? Dates. Oh, come on. Got to be a date here somewhere. Oh, here you go, 117, 121. So they just sold for 26. And these puts have a 59 delta, and we're down a couple of bucks. Let's say we're down $3 is $1.50. So it should be 24.50. Yeah, so we'd want to go on the high side. So basically we want to look at, like, let's say 23.25. So sell 10 NUE 2027 $. I always try to put in a number I think is obtainable. And it doesn't, and you don't want to force it right away. You want to ask for what you're asking for. 23, 25, $23,500. Okay. And that's how we decide on a trade. Then I check the math to make sure I'm happy with the trade. And it's 38, whoop, 38.5 minus 23.5, 15,000, same 15,000 as it was before. And then minus, well, we know that, 7,500. So it's net 7,500, it's the $30,000 spread. And and when you put your orders in, by the way, this is very important. So when you put your orders in, I always do individual legs. So I want to buy 10, and the trading range is 37.80 to 38. So I'd say I want to buy it for 38. Don't ever let them tell you what you should pay, because here I'll explain why. So I put that in for that, but I don't put limit. I put good to cancel. Not a day trade. I put it in good to cancel. So I'm going to offer 38. I always want to offer less than they're asking, a reasonable amount less. So I'm going to offer 38. And then on the short ones, I want to sell. I'm going to sell 10. And they're saying that the range is 22.40 to 23. Now here I want to be high. So I want to be at, let's say, 23. Okay. So all you do is this, very easy. Okay. And then you make it good to cancel. I keep doing that. Wait, limit. Yeah, so you always want to put in a limit order. That means only at your price. Okay, your price or less. So I'm willing to sell for 23 or more. I'm willing to buy for 30, whatever the hell I said, or less. And here's the thing. The stock's going to go up and down, right? One side or the other will fill. They can't both not fill. Well, it could conceivably stick right in the center for days and days and days, and neither one fills. But that's highly unlikely. Any little fluctuation will go one way or the other. And more often than not, within a few days, it's going to go both ways. And you'll get both sides. So when you put in your initial trade, ask for a good price on both sides, because if the side that fills will then dictate how much flexibility you have. So one side will fill at a good price because you're asking for a good price on both sides. Then once it fills, even if it partially fills, then you can say, am I still being realistic about the other side? And that's when you make a decision. But if you're generally bullish and you fill your long calls first, then don't worry about filling the short calls. Okay, you're bullish. You don't want short calls. You're not worried. You shouldn't adjust and force yourself to have lower price short calls when you're bullish. And if you stop being bullish, then you can make an adjustment. If you start getting worried about something, if the whole market is crashing, then make your adjustment. But don't do it just because you're panicking to make a fill. That doesn't make any sense. You were bullish on the stock. Same thing goes for the puts when you fill the puts. And also very, very important on the puts, if you don't fill the puts, if you filled your long calls and you didn't fill your puts, why would you be worried? You have a bullish position on the stock and your short puts aren't filling. The only reason your short puts wouldn't be filling is because your long calls are doing well. So when you're working your way into a trade, think about what your goal of the trade is at all times. And when you start putting up legs, you need to say to yourself, am I now bullish? Am I now bearish? What am I doing? If you're bearish on something you meant to be bullish on, that's a problem. But if you're bullish on something you meant to be bullish on, how is that a problem? How is that ever an issue? And certainly don't ignore NUE. While you're buying, pay attention to what's going on. You can zoom in on it. Okay, so this is 122. This is still days, but it's 122 here. You can go from days to hours. 10 days, 30 minutes. Okay, you can keep an eye on it. You say, well, right now we're weak. We're down 1.95%. This line has been holding for the day. It's probably a good time to sell some puts. It's a good time to buy some calls. And maybe I want to wait for a bounce a bit before I sell the short calls. That's your day trading. That's your intraday plays that you can make on stocks while you're filling positions. And it doesn't have to be one day. You got it. Then you got to look again. Now you have to say, okay, that's a 30-minute chart. How does the 1 hour chart look? And you say, okay, well, realistically, while we may be down for the day, we were certainly lower earlier in the week. Okay, and if you go from the hour chart, you got to keep taking different views. Here's the daily chart, but from the daily chart, see how it very much matters how you're looking at something. On the daily chart, we just hit a bottom. So when you think you're toppy, you're only toppy in this 1 hour, in this hourly chart range. We bottomed out in December. We're up now. Now I'm going to go back out to here, and I'm going to say NUE. Oh, it was over there anyway. I'm going to see NUE. What happened? Well, they put out their dividend on December 31st, and since then, so for whatever reason, people were selling into that. Then they have the dividend. Now people are kind of up, but today we had a little pullback. And the last earnings were not particularly great, but look at the miss. Surprise, minus 0.015. Surprise, minus 0.12 cents. Well, that's pretty big actually for earnings. But the revenue came in. Look at the revenue. So nothing terrible seems to be happening. This one was a beat. This one was a miss. And it's steel. It's a tricky business. So I feel good about picking them up at this fairly low point in their range. So weekly looks good. Monthly, like I said, is scary. So we're a little nervous, but we're taking a spread that has a tight range that we're happy to double down on. That's the trade. All right, so let's get back to so you don't realize I get it might be a little subtle, but I mean this is what's all going on in my mind when I'm talking about these things. And it's like, yeah, we'll get back to this later, make some trades out of it. Here's Thompson. Now of these, I want to figure out which one is the best bet. So Thompson is 163. So now I'm going to say, okay, how does Thompson look? And Thompson's trading at 40 times earnings, but our premise is that a lot of work is going to get thrown their way. Okay, lots of in their consulting services, their legal lookup services. There's a lot of corporate changes going on. So figure people already use Thompson. This many people already use Thompson. It goes up on a regular basis because they're charging fees. It's kind of like LexisNexis. They got huge databases that corporations run every single day and use information. Now, what happens if corporate activity ticks up and they start using more and more of the service? Well, then that's fantastic for Thompson because it's data and they're just supplying more data and charging more money, and they can tick up very easily. And look what happened well, this seems weird. I don't know what that was. That's one of the things you want to check out when you're investing is what the hell was that? And how did that happen? And did it happen? What could it happen again? But net profit, apparently they do have that once in a while. They have these giant net profits for whatever reason, but 15, 11, even during COVID, not losing money, 56, 13, 23, I'm sorry, 26, back to 17. So this is a lull in a cyclical business. The revenues are there, and we are entering a cycle that we think is very favorable to these guys. Do they have any debt? Yeah, they have a couple of $1 billion worth of debt, but that's not a lot because the market cap of the whole thing is 73 billion. They'll survive, and they make 2 billion a year, so they'll survive that. So overall, seems like a decent enough company, right? On a 5-year chart, just basically growing along the line. On a 10-year chart, they're growing along the line. So this is a steady growing building company. It looks like it's in pretty good shape. If we ever got these things to work, we could research it. Look at this. It's deader than a doornail. Like, I've never seen this happen. Never seen this platform stop like that. That's really sad. All right, anyway. Fortunately, I know enough not to need it. So anyway, there's a huge environment that makes them attractive. Are they super attractive? Are they super cheap? No, they're not, but it's interesting enough where I think I wouldn't mind a short put on them. So let's say TRI. Oh, uh-oh. Nope, they fail. They don't have long-term options. So I'm not interested. So now I'm just going to skip past them. I'm not interested in selling. This is ridiculous. First of all, look at the spread on these things. It's like nobody's trading these at all. They have such wide spreads. Obviously, nobody's even bothering to trade them. Even the Aprils the spread is 970.14. So for that reason, low liquidity. I'm not interested. Also, July, they don't go past July, and the July 160 puts are let's say I even got $6 for them. So what? That's not enough. It's not enough leeway for me to take that risk. I'm not getting a good enough discount to worry about it, so I'm not going to do it. All right, so that's been eliminated, and I do that all the time. It's like I always look first and analyze the company, and then I go to the options and I go, oh, son of a bitch. So now we'll look at CNA Financial. All right, this one I love. And why? Because they provide liability insurance for law firms. So more legal activity. See, it's a funny thing, right? Because when you think about it, like, you can't bet on law firms because law firms are almost all LLPs. There aren't really many. I can't even think of any public law firms because the whole concept of a law firm, you make partner, you share in the profits, blah blah blah. Not the shareholders. The last thing the lawyer wants is to share profits with shareholders. They share profits with their partners, right? So your goal as a lawyer is to make partner and share the profits of the firm as a partner, not stockholders. So law firms are not public companies by and large. CNA, though, is a side way to get in on it because they provide liability insurance for law firms. It's a specialty insurance. They have a very large market share. There's not a lot of competition for them, and they're functionally, they just grow with the legal fees. Now, legal fees should be going through the roof because all these companies need to restructure and re-identify and adapt to the trades and the tariffs and everything else that goes on. That's going to make huge amounts of work for law firms and huge amounts of work for CNA, who take on more, whose liability basically is based on the billings. They, that's their measuring stick. They say, what are your billings? Here's your percentage of liability. So this one's fantastic. I bet they don't have good options though. Nope, only out to August. And look at the width. When you see this kind of spread, it's not traded heavily. So there's no point. I could look and figure it out exactly, but there's no point. This is useless. So can't trade them either. Oh well, move on. So I like them a lot. They probably pay a dividend. Let's take a look. Yahoo, Yahoo, Yahoo. Dividend 3.6%. But now, see, even if the options aren't traded heavily, you can still buy the stock for $48. You can sell the $50 calls for $250. That was the last trade. So you could sell the $50 calls for $250, and you're going to collect your dividend, and you're going to collect $250. So when's August? Is 200 days, right? So there's 360 days. It's almost half a year. So basically for 6 months, you're going to get 250 divided by 48.34. So you're going to get 5%, and the dividend is 80 cents more. So that's 80 divided by 48.30. And that's 1.6%. So this stock, if you want to pick it up for the dividend, is going to pay you 6%, more than 6% in 6 months, and then you're going to get another 6%, so you get 12% a year from this stock. That's useful. That's a nice little return. And if it goes down, who cares? You're just going to sell more dividend. You're just going to collect more dividends, sell more calls, and you're going to drive your basis lower and lower and lower. And eventually your basis will get to zero, right? We're going to sell $5 a year in puts and calls and $1.76 in dividends. So that's 6.76. Well, 48.34 divided by 6.76, 7 years. So in 7 years, if you just do simply collect the dividend, all right, and 1/7 is your rate of return. So 1 divided by 7 is 14%. So it's a 14% annual payoff. But you look at it a different way and say in 7 years, if you do this, you will have a zero cost basis on the stock. You're going to take $48,000, right now. Take $48,000, you buy 1,000 shares, and 7 years from now, you're not touching the money that comes in. 7 years from now, you will have $48,000 cash, and you'll still have the stock. So you'll have all the money back, and you'll still own the stock in 7 years. Then 7 years later, you will have another $48,000. That's your payoffs from selling calls and dividends, and you'll still have the stock. So now every 7 years for the rest of your life, you will get your $48,000 that you put down on the stock. That's why it makes sense. And if you, let's say you were to take the $48,000 you get back in 7 years and double down, then you're collecting twice as much money. So 7 later years, you will have, so at the beginning, you have 1,000 shares, then you get your money back and you have 2,000 shares in 7 years, right? So now you have 2,000 shares and you get double the money back. So in the next 7-year cycle, so it's 7 and 14, and in the next 7-year cycle on year 14, you have 2,000 shares and you have, 100,000 in cash basically. So now you take the $100,000 in cash, this is year 14, and buy 2,000 more shares, and now you have 4,000 shares. So now in year 21, you have 4,000 shares, and you're collecting $200,000 every 7 years. And it's, what year we say, 21 years from now? So it's basically 2045. That's why it's worth doing. You start with 48,000, and 20 years from now, you're getting paid $200,000 a year, and you still own $200,000 worth of stock. So you basically have $400,000 of assets that you're going to have between year 21 and 28. That's 10 times. That's a lot. And that's all you got to do with a simple little stock like this. And you're not even selling puts. You're not doing anything fancy. All you do is every 6 months, you collect your dividends and you sell some more calls. And all they can ever do is call the stock away from you at more than you paid for. You can never be harmed to the upside. To the downside, sure, the stock can lose money. Maybe something bad happens, but if you keep track, it's not, you ignore it. But if the stock continues to exist, you will eventually get to a zero cost basis, and you can do this with any stock that pays a dividend. Actually, the stock doesn't even have to pay a dividend, but any stock where you have a reasonable way to do this in a reasonable amount of time is worth doing. And AT&T is one of those stocks too. But that's where you want to have some steady, boring stocks and run this scenario with a conservative part of your portfolio. So in other words, you know, if you say to yourself, I'm going to retire in 40 years, what can I do to make sure I'm going to make money? I'll say whatever income you make today, if you can put that away into a stock like this, then by the time, not even 40 years, but let's say by the time 40 years rolls around, you will be collecting more money than your income, and it will adjust for inflation because dividends go up and the stock goes up with inflation. You will be collecting the income you're collecting now for the rest of your life without touching the principal. That'll be just your stock and dividend sales will be that much. And you will also have a huge amount of money, 5-6 times what you started with, to leave for your kids. It'll continue into their lives too when you're gone, because it's, instead of just being a lump of money that you're messing around with in the bank or an IRA or a bond, it's a freaking working company that throws off returns and throws off dividends and throws off capital. That's the way to make money. You don't have to be super aggressive. You just have to let math take its toll, basically. Where were we? So anyway, so CNA, so too boring for us generally at PhilStockWorld, but it's not boring. It's a good way to make money. Huron Consulting, and again, I'm not sure how what the options like. Regulatory compliance, I mean, it's a no-brainer, right? So we're going to say HURN, and again, not very big on the options, unfortunately. But unlike the other one, these are decent payouts, right? So at 128, I can sell the 130 calls for September for 13 bucks, 14 bucks, something in that range. I can sell puts. The puts are not that attractive, but I could sell further out of the money puts where I don't mind investing. Well, not thrilling. I'm not thrilled by those numbers. The call numbers are good. So apparently there's a lot of people betting they're going to go higher. You know, it's like a horse race. You're betting on the favorites, right? So it's pari-mutuel betting. There's a lot of people betting they're going to go higher. Therefore, the call prices pay way better than the put prices. This is not bad. And then the tie break. So now the options aren't terrible. They're a little short term. And so then it goes back to on HURN. How confident do I feel in the trade? Well, they're trading at 18 times earnings. That's not bad. They do not make a lot of money. They do 2.2 billion in sales. Look at the growth. 9, 1.1, 1.3, 1.4, 1.6. That's good, steady growth, 10% average growth. The profit is growing right along. Well, that was a bad year. But the profit is generally growing along. And by the way, people can have bad years and they can invest. And I like it when somebody invests money to grow. And it seems like they do this on a regular basis, like grow, spend some money, grow more, spend some money, grow more. This is a good company. It's managing their growth well. They just have a system where they spend every couple of years. They'll push themselves into a spending cycle to get bigger. But now everything's coming up roses for these guys. So I don't mind them for a small play. It's not so exciting though that I'm going to put it into a portfolio or something, but it's a good little play. I would sell these puts, the 125s, just to see how it goes. So I would only sell a few, maybe, depends what you have. You know, it depends on how much you're willing to buy. Let's say you're willing to buy 25,000, right? So you sell two. Just sell two puts. So you sell two puts for like $9. That's going to be 1,800 bucks. And then you buy 128. Now, when I'm buying, I say to myself, okay, let's say I can get these for 16. I can get these for can get those for 19 or 18.50. So that's cheap. That's $2.50 more for $5. I'm going to pay that. So then I said, what did I say here? $18.50. So let's say we're at $18.50 here. Are these going to be $21.50? They don't look like they are. Are these going to be $26.50? These look like they would be. So I don't see that these are a good price, but these, if I can get them for $26.50, that seems worthwhile. So then I'd like to get the 110. I'd like to get the 110s and then sell. What do we say these are going to be? $26.50. So if I get the 110s for $26.50 and we sell, what are these? 130s. Oh, and we sell the 130s for, let's say $13.50. That makes it $13 on the $20 roll. I don't like that. The 135s, we can sell for, let's say that's 10, let's say 11, 12, let's say 12. But these we could sell for 10. I don't think it's going to go that high. So I'd go for 12. So that's the kind of spread I would go for on this thing. It's not exciting enough to say I want to make that a trade, but it's not a terrible play. So I like it, but I don't love it. See, you wonder why there's not that many trade ideas, right? I go through these all the time, but then I say, yeah, you know what? No. Robert Half. I like Robert Half. I hope they have good options. Son of a bitch. No wonder we don't play these things. But at least they're traded often, because you can see from the spreads that they got a reasonable spread. So 13.20, 14.20, 9.60, 10.50, 4.40. This particular option didn't trade, but that doesn't mean it's a bad thing. 4.40 to 5.50. So at least there's reasonable amounts of trading activity here. It's a decent percentage of the price of the stock. So the stock's 70. I could sell 70 calls for $7, 10% there. I can sell the puts for another $5 or $6. 560 was the last one. So if we can sell these for 560, and we can sell these for $7, right? That's 1260 divided by 70.6. That's 17, 18% in how long? 240 days. So about 2/3 of a year. But that's a pretty good payback for that. It's not, though, unfortunately, the kind of trade that we generally go for in our portfolios, because it's not the best use of our cash. We can make more money. So it would not be something I would put in the portfolio, but it's a damn good trade. And here's KKR. They are already, way up. They were 60 and now they're 160. So they're crazy, but M&A activity and corporate restructuring is what this firm is all about. They are capable of making so much money that I kind of like them, even though they're way up here. I'm sure they have long options, KKR. So they've got options to whatever we want. So now we have to say, how reasonable is this? So first of all, does anyone believe they're going down? Not really. It's not a great price. Notice from 160, which is basically the strike price, going down $22, going up, where's 160? Going up $35. So think about it. 22 is the bet going down. 35. It's like a horse race, right? This is such a long shot that it's almost 2-to-1 that they're going to go up from here. Now, maybe that's not bad, though, because for me, what's it saying to me? It's saying if I want to sell the 160 puts and calls, they can't both lose. I can sell 35 here and 22 there is $57. $57 divided by 161, it's 35%. Now, remember what we were talking about, how on the other one, that if it knocked off 14% every so often, that it would take you 7 years to zero out your stock. Okay, if you sell puts and calls on KKR, it only takes you 3 years to get all your money back by selling puts and calls. See the difference? 3 freaking years and you will have collected all your money back on the stock. Now, realistically, it's not going to hit 160 on the nose. It's going to be up or down from there, and you'll win one side and lose another. But you know what? Let's say, well, let's say we picked, where's the current month? Okay, so let's say we thought it was going to be 140, right? And we sold the 140 puts and calls for, well, hang on. Where's the freaking thing? Here. No, because they're kind of steady-ish. I mean, not terrible. Anyway, so let's say that 2 years ago, so it's 25. Let's go back to 23. Well, we'd be in trouble. 2 years ago, it was at 60. All right. So let's say here, let's say at 99 bucks, we sold the 140 puts and calls. It doesn't matter. It's too confusing to try to square it up. But let's say we had sold the 140 puts and calls. Doesn't matter where the stock was when we did it. All right. So the 140 calls puts are dead. The 140 calls are $21. So if we had sold them for 50 combined, we would be up 30 bucks. So no, we didn't get 50 something knocked off the price of our stock, but we got 30 bucks knocked off the price of the stock. And what do? We take the losing side, which is $22, and we now roll that. Whoop, the hell? And we now roll that to the next spread. And so we really won $30,000. We're closing it with a $30,000 gain. And now in the next cycle, we're going to sell the 160 puts and calls for $57, whatever I said it was. And boom, the next cycle begins. If we have to give back 30,000 out of 50,000 on those, we're still up 20-something thousand dollars. But as we do it, we widen the spread a bit too. So we're only rolling the losing side. The winning side expires worthless. The losing side, we roll to a different strike. And eventually, one day, if we're lucky, we thread the needle and come in between the two strikes. And if we do that, then everything is worthless and we're good. So the best case scenario, if you hit 160 on the nose 2 years from now and did it 4 more years in a row, you would then make your entire stock back. You probably won't. And you'll probably make less, but even if you get 30% back, 40% back, you're in great shape. If you get 40% back in 2 years, then you're gonna be able to make a fortune. You're gonna pay off the entire stock, and then you're into the same situation that I described before. And this is how you build wealth. And this is, in fact, this is how we work the butterfly portfolio. And this is why the butterfly portfolio starts becoming like this. It's like a broken money machine. It's like money just starts flying out of it, because this is exactly what we're doing. We reduce our basis, we increase the size of the positions so that we're selling more and more and more premium. And we're not really going for dividends in the butterfly portfolio, so it's mostly all about the premium sales. But in other words, we have these positions that as they age out, they have no cost basis, yet we're spitting out, the entire price of the stock every few years. That's why it works so well. Let's see, where are we? So there's KKR, good candidate. Then CBZ. Okay, now this is an accounting firm. This is nice and boring. I love boring things, but I bet they have no good options to trade, unfortunately. Ooh, better than I thought. Let's see. Oh, only July. Okay. but at least they're trading. It's oh man, it's not great. $5 spreads are a lot. So they're at $84. Look at that though. It's oh, tough. It's a huge price. The 1410 was the last trade on the 80s. How about on the downside? Oh my God, no, they're not trading. No, not liquid enough. Pass. And I said, and we'll take a closer look at these opportunities in the webinar. Yay, then we did it. Then we talked about that. Then we talked about Netflix. Don't care about those stocks. Netflix, Disney. I do like Comcast. So let's take a look at Comcast. CMCSA. So Comcast, yes, Xfinity, that's a good reminder. Comcast is your cable company. So they have a steady, reliable stream of income coming in no matter what they do. They also own NBC. All right. They are trading at 8 times earnings, which is pretty freaking good, $141 billion, but they're making $16 billion a year. It doesn't grow much, but they will eventually get a price raise in that'll boost them significantly. As you can see, doesn't matter COVID, they don't code. They're like, what COVID? You didn't shut your TV off when you had COVID. So, so 94, 108, 103, 116, 121, 128, 123. You know, and they're also universal with the theme parks and stuff, but the money is really from the cable. And the profits are pretty steady. I don't know what they did in 2022. I'd want to look at that closely, but basically you can tell they got right back to normal. So they invested something, did something, whatever they did. Debt, $90 billion. Well, that's a little scary, and that's why they're trading so low. $90 billion got to be a concern, but still, look at those earnings per share from 2020. Look at it going. That's their income. That's their this. So they can handle the debt. They're okay. And it's a crazy big company. They're trading at $37. That's good, by the way, because it's always more difficult to trade with the options when something is very expensive. But this is CMCSA. Obviously, they go out all the way. So let's say we bought Comcast for $37. They pay a dividend too of some sort. And whether you buy the stock or not, the dividend is helpful because it makes other people buy the stock. So they're paying a nice 3% dividend. That's going to keep a lot of people invested because most people don't have any idea what to do with options. And so it's not something they're pursuing. But rather than collect a 3% dividend, we say, okay, we're willing to buy, oh, Jesus, look at that. We're certainly willing to buy Comcast for $35 if you're going to pay us $4 to do it. That's $31 net. That's $6. That's 20% below the current price. So that's like free money. All right, I'm going straight to this. Oh, where are we? And here we're going to say sell. Sell. How much Comcast are we willing to buy if it's in the long-term portfolio? Do we already have it is a question. Might already have it. Sell 20 CMCSA $2027. What did we say that was? $35 $5 puts for $4. And that's $8,000. Then we're going to buy, probably buy 40. Let's see what we can get. So it's a $35 puts for 4. Now, on the buy side, I think they're too cheap. I think they're a great buy. So let's say we buy the 35s. So the 35s last traded for 7, but they say 689.10. The 3250s though are 850. I find that more attractive, I think. Oh, and these are only 9. So these are 850 and these are only 985 or 9, yeah, see 985. Well, I would pay the extra money for those, right? Because it's 850 and these are 985. So it's $1.35 more to get 250 more in price. I think that's fair. So we want to buy the 30 calls for 985. So let's do that. So we're going to buy CMCSA 2027 $30 calls for 9.85. And that one I do need a calculator for. 985 times 40, 39.4. What a ripoff. $39,400. And then what do I want to sell? Well, we think it's a good price now. We just bought the 30s. We don't want to sell the 40s. The 40s are $4.85. That would give us a $5 on a $10 spread. That's fine. But we think that's cheap. No. Geez, $5. That's not bad though, but this is only a little bit more money. Okay, I'd rather sell those. So these are $4. 4250s. So now we're going to do sell 40 CMCSA 2027 4250 calls for $4. Oh, that's easy. It's 16,000. See that? You start using it's like a crutch. All right, so that's net 23, not quite 23, minus 8 is 15, so that's $15,000 on a $50,000 spread. That's perfectly reasonable, but we can also, since we have 40, and that's why I wanted to do 40, we can sell 10, 1/4 CMCSA. Now we're at 37. Let's say, we'll see the Aprils, the 3750s. Yeah, we may as well collect some money we'll see what happens. So we'll sell these for 155. 3750s for 155. Whoop. Oh, I just closed the wrong thing. I hope I didn't close it. See, and it seems like a little bit, but the spread is 39.4 minus 16,000 minus 8,000. So the spread is 15.4. And so 1550 divided by 15.4, that's 10%. And that's 10% in 85 days. And we have 723 days to sell. So 723 divided by 85, we have 8.5 times to sell. So after we sell this, we have 7 more chances, 7 times 15. We can collect $10,500 in premium. And what do we know? The only thing that we know for an absolute fact in trading is that all premium expires worthless. Now, that doesn't mean that the stock can't be above or below your strike price, but even no matter what it is, there's no premium left when it gets to that point. So you're being given $10,500 in free money. And that's against a spread that we only spent $15,000 on. So we're going to recover 60% of the spread price by selling these short calls. We're going to drive our net down to $5,000, still going to be a $50,000 spread. And that's in 2 years. All right, so that's why when I talk about those other stocks, and you're like, oh, Phil, why isn't that a trade? Why isn't that a trade? Because we can do so much better. Because that's chicken feed for us, because we know how to do this. And this is going to make you a very wealthy person if you stick with these strategies over the long haul. All we're doing is buying a stock that has a good value. We're wrapping it in the options. We're not really buying the stock, we're proxying the stock. So we're not using a lot of cash to make our purchases. So here we're using $15,400. If Comcast hits 42.50 and it's at 37 something now, it's at 37 now. If it gets to 42.50 in the next couple of years, and of course we're buying it because we believe it's a bargain, then we will get $50,000 back on our 15.4. But while we're waiting, we're going to sell $10,000 worth of these things, and we're going to drive our basis down to $5,400. Now, what's our exposure? If it drops, we're going to end up owning 2,000 shares of Comcast for $35, which is $70,000. All right, so we're risking owning $70,000 worth of Comcast, but Comcast is a great freaking company. And what happens if we end up owning it? We sell puts and calls and lower the price again. So we won't really own it for $70,000. We're going to drop our, well, look, if we get assigned now, let's say we got assigned right now, and we have $70,000, we have 2,000 shares of Comcast, it's $70,000. Was it 20? Did we sell 20 puts? Oh, we did. Okay. So we get assigned Comcast. We have $70,000 worth of Comcast. And what do we do now? I say, oh, what do we do now? Well, let's say Comcast is at 30. So it's worth $60,000. So we could be down $10,000. It's not like we're going to get wiped out because it's Comcast. It's not freaking some, it's not like a quantum computing stock that may actually be worthless in the end. It's not a drug company that runs out of patents. It's Comcast. They're providing cable to everybody. There's competition, but cable is, you know how cable is. They're very intrinsic. They're very locked into their base, and there's not a lot of competition locally. I'm sure Elon Musk with his Starlink is going to try to do a lot of stuff with his thing, but it is not cheap. Starlink's nowhere near competitive to cable. And it'll be many, many years before it is, so I'm not too worried about it in our horizon. So if I got assigned 2,000 shares and it was at 60, then what would I do? I would sell the, well, it wouldn't be the 60s because the 60s would be probably, all right, I'm sorry, let's say we're at the price we're at now. It wouldn't be 60, sorry, I meant if it was 60,000, if it's 30. But it's tricky with the math, so let's just say it's at 35. So what are we going to do? We're going to sell the $35 calls for, let's say, $6, and we're going to sell the $30 puts. It would be lower, so let's say for $3. So now we're going to collect $9, and now we've knocked $9 off our net entry. We're going to collect, if we cover all 40, we're going to knock $9 off the total price of 30, and we're down to 21. So again, it's a chess thing. It's like I'm not asking myself if I want to be assigned 2,000 shares of Comcast at 35. I'm asking myself if I want to own 4,000 shares of Comcast at 21. And the answer to that is yes. I cannot foresee a situation in which I won't be thrilled to have 4,000. And how much is 4,000 at 21? It's $84,000. So I'm committing to 60 or 70. I'm committing to 70 here with this short put sale. But if I roll and I sell puts and I double down, I'm only committing $80,000 because I'm committing at a much lower price. I'll have 4,000 shares at 80 instead of 2,000 shares at 70. That's a no-brainer. So that trade is not what I would consider risky. I'm going to write that down too. Oh, we already did. Okay. All right. So, well, all right. So that's where we are with that. So that is what I wanted to do today. I hope it wasn't boring, but I mean, that's the process. That's what I do every day. It's like I could look, sometimes I could look at 20 different things and come up with nothing. And there were more, I think there was some more that we discussed also in the trades. But anyway, though, so that's two. If I find two stocks in a day, that's a lot. I mean, I'm freaking thrilled. And I've known I wanted Comcast for a while. This is just a catalyst that makes me want to buy them now. And Nucor is the same thing. It's like the trade thing, I think will be good for them. We might miss our opportunity, so I'm kind of motivated now. But that's what it is. You got to dig and research and dig and look at more stuff and look at other factors and go back and forth. And then eventually we come up with things that are extremely likely to work out. And also with a good enough return that it's exciting for us, because our portfolios, as you know, they make a fortune. So we want to, we want something that fits in the portfolios, not something that's going to squeeze out 20% a year. It's like this, so what? It's not a good use of our money. We can do better. And when I say we can do better, I don't mean gambling. I'm talking about two blue chip stocks. We polished away all the dirt, and we have two little diamonds, and they're two blue chip stocks that are clearly currently undervalued, that clearly have some forward catalysts, that also have good options to trade that will give us a really strong return of several 100% if everything goes well. And all those factors come together. And in a normal situation, I don't know what's going on here, but in a normal situation, we would have also bulletproofed them and I'll deal with that next week. We also would bulletproof them by going through back and forth with my AIs, or going back and forth in long research, which would take hours, so you don't want to do it manually. And I would be saying to them, hey, what could go wrong? Let's talk worst case scenarios. Let's talk what's wrong with the company. What's the good, bad, and ugly report? You guys have seen those. I'm like, what's good about the company? What's bad about the company? What's terrible about the company? What could I be wrong about in my economic assumptions? These are the conversations I have with the AIs to make sure I'm not missing something. And it's great. But that's the work it takes. I mean, we just went through basically. We just spent 2 hours going through this one set of possible trades, and we came up with 2 of them. And this is how I spend my day. And by the way, getting to these trades was hours and hours and hours of work just to come up with a list of possibilities that I thought might work. So it's a lot. Fortunately, I enjoy it, but it's a lot. And anyway, so I hope you guys learned something. I hope this was worthwhile, and I will not torture you with this again for a bit. But I think it's important once in a while to say, here's how we make the sausages. All right. So thanks everybody for coming. I appreciate it, and I'll see you again next week. All right. Take care, folks.